So hello everybody, I'm back, and this is now chapter 9. We're going to go over chapter 9, and there's not really a lot of slides here, but we're going to talk about projecting financial statements here. And once again, here's the infamous box with the 5 stages, and now we're on rapid growth stage, right? So that's the highlighted one. And we're going to look at forecasting sales, right, for seasoned firms versus early staged. And this was the infamous sustainable sales growth rate equations, and that'll be the big emphasis in this chapter. Okay, so and here we talked a lot about this already. Percent change in growth or holding period return. Remember, I was showing you these numbers, and we got a 10% there. So and here's the basically the forecasted the sum of the growth rates, right? That was the sum of the probabilities times the returns. So this is like a quick review. And again, here I just show you some of the equations for early stage forecasting. And again, this is just changing the numbers a little bit. So that's not... Okay, so here's the emphasis now. The emphasis on the sustainable sales growth rate. And basically the sustainable sales growth rate is the rate at which a firm can grow sales based on the retention of profits in the business. These and the internally generated funds, this is your net income. You should have these on your sheet, right? Because I could do a true or false on those, right? So you should know those two statements. All right, so let's look at the sustainable sales growth. Remember, we went through this equation, and we said it was in many forms. So it was in 1 form, 2 forms, 3 forms, 4, 5, right? And basically 6 here, right? So all these should be on your sheet, one way or another, to get the sustainable sales growth. And another way to do it is with getting the operating performance using some ratios here, right? So return on equity is equal to these 3 ratios from 330 or 365. So here's 1, 2, 3. So net profit margin is there. Asset turnover is here, and equity multiplier is there, and here's that retention ratio. So basically the other way is if you have your return on assets times your financial policy. So this is another way. So there's about 8 different ways to get your sustainable growth rate, as you can see, and that's the main emphasis in this chapter. So all these should be on your sheet. Okay, so the financial capital needed, true or false, it's the financial funds needed to acquire assets necessary to support a firm's sales growth. All right, so spontaneously generated funds is increases in accounts payable and accruals that occur with the sales increase, right? So basically, you have to, you're going to have generated funds. You're going to have to pay higher accounts payable, right? So you have a sales increase, so you're going to end up you have to generate more funds, right? Obviously, you're going to have to hire people, or, right, more wages. Okay, so additional funds needed. How do we define that? Well, from the previous slide, it's spontaneously, it's required increase in assets minus your spontaneously generated funds minus your increase in retained earnings. So if you see this additional funds needed here, and I'll highlight this, right? You know that you're going to need 3 numbers here to calculate that, right? You'll need 3 numbers here. And those 3 numbers, you'll need an increase in assets from one year to the other, the spontaneously generated funds, and the increase in retained earnings. And remember this equation here. This is a big equation. Again, this should be on your sheet. And this defines everything here. And the most important point with this equation is to basically look at the example here. And if you have any questions where these came from, either go back and look at the income and balance sheets, or email me and I'll explain to you where these numbers came from. So those slides 12 and 13 are most important. Okay, so there's a couple ways of projecting financial statements. And one is called the percent of sales method, and the other is called the constant ratio method. Right? So that's all you have to know, those two. All right, this is not something you have to worry too much about here. And here's a projected income statement. Please just go over these. You won't have to know too much on that. All right. And basically, they're just showing you how to. Here's the actual. Remember, this was the actual, and here is the forecasted. Everybody remember that? Here's the forecasted. And here's the balance sheet. And here's the statement of cash flow projected. All right, so that's really it. Basically chapter. In all cases, you should be reading the chapters though to fill in what I'm talking about. Part of this class is to read the chapters in the book, and I suggest you do that also. Alrighty,